Okay, before we head in, I've got the Discord screen open. There is a channel called Market Outlook. I will be on at 6 p.m. Eastern Time, answering any early questions any of our Discord members may have about the Market Outlook, which is 4 p.m. Costa Rica time. I'll be on for maybe an hour, hour and a half. I'm choosing 6 because that's when Globex opens and I can see how futures are opening and how currencies are opening. We'll see what's going on with the euro in this Market Outlook coming up. I do talk about the euro. If you're not an applied level subscriber and you don't have access to the Discord, in a couple of weeks I will be opening up an option for YouTube subscribers to have access to this particular channel on Discord. But it is going to go through the markmeldrum.com site. So you're going to want to go to that site, markmeldrum.com, and just open a free account. There you will have access to the Level 1, CFA Level 1 from 2018. And there will be a use for that because your role, if you're just from YouTube, your role will not allow you to contribute to the conversation and will not allow you to enter any of the other rooms, just the Market Outlook room. And you can only read the comments or listen to anything live, but you won't be able to contribute. However, I am going to do something with that free Level 1 that allows you to build the qualification, which will then increase your role to be able to be a participating role. If you are an applied level subscriber and you haven't joined the Discord yet, go to markmeldrum.com, log in, and just navigate to start moving towards any of the applied level videos. On your way there, as you click from screen to screen, you will see on the, let's see, it's the right side of the screen, a thing that says join us on Discord. You just click on that and you'll be in. But for everyone else who's in Discord right now, I will see you on that channel at 6 p.m. Eastern Time. Well, another volatile week behind us. I'm going to start this week with the data from the jobs report. And if you hear some noise behind me, that's because the pool cleaners are cleaning the pool and not being as quiet as I would like them to be. So that's all that is. The household and establishment surveys are telling two very different stories. Let's start with the establishment survey. Total jobs, 151,000. I was actually surprised by that. I was expecting something lower. I thought the greater probability would be on under 100,000. So again, this economy, quite healthy underneath. But one man seems to be working very hard to make sure that doesn't stay that way. Private payrolls, 140. That makes only 11,000 for government. Usually they make up about 17% of payroll. So at 151, you'd expect about some 25,000 to be government, only 11. I think quite a few departments have hiring freezes on. Average weekly hours, 34.1, which is still quite low. Average weekly earnings, 0.279, which is consistent, at least with what the Fed says, consistent with 2% PCE. They say anywhere between 3.5% and 4.5% is consistent. We have 3.4% annualized if you take this and annualize it. The diffusion index is a little bit confusing here. Total is 58.4. Anything over 50 is expansion. Manufacturing, they're pegging at 54.9. But the PMI, the ISM's PMI for manufacturing, the sub-index for employment, came in under 50, meaning contraction. And S&P's measure also for manufacturing came in under 50, which means contraction. So you have two private market indexes showing contraction, but here showing expansion. Let's jump over to the household data. There is a completely different story. Labor force actually shrunk 385,000. Participation rate dropped 62.4, down 0.2. Employed, a loss of almost 600,000. So compare that, negative 588 versus plus 151. Unemployed increased by 203,000. Breaking into the details a little bit, less than high school job losses. High school job losses, BA or plus job losses, only gains between more than high school but less than BA. I think the more damaging one is here. Look at this. In terms of full-time jobs, negative 1.2 million, and part-time jobs plus 610,000. That's big, negative 1.2 million. Retail lost jobs, 6,300. Last month they had gained 29.5, and this is coming off of quite a few months where retail, I think 5, 6, 7 months, as far back as at least that I can see without digging into deeper reports, had been positive. So this is two issues. Number one, it's a fairly large magnitude, the 6,300 jobs lost, but the change of sign is important. When we look at temporary and leisure, you have larger magnitudes than the month before, but you have consistent signs, right? So temporary down 12,300, previous month down 10,003, leisure down 16, previous month down 14. Sorry about the noise in the background. This is what you get when you have an outdoor office. So we'll just keep going here. This is what I have in white. This is a report from initial jobless claims, and I think this is going to become more and more important, especially the bottom panel down here. And I'll get to that in a second. Let's just point out some numbers in here. When we look at the week ending February 22nd, the insured unemployed, almost about 1.9 million. And it gives you a number down here. The insured unemployment rate is 1.2%. The unemployed is 7.05 million. For February of 2025. February. Last February, the unemployed count on the jobs report was 6.4 million. So year over year, you've got an increase of about 550 to 600,000 on the unemployed. When we see the 1.9, those are the ones who have unemployment insurance. The rest don't. So you have an unemployment rate of 4.1%, but 1.2% have received benefits. The rest don't. Let's look at that bottom panel because I think this is going to take on more importance. This is UCFE. That means unemployment compensation for federal employees. So we'll be able to see how many individuals filing initial claims were federal employees. And DOJ can only cut federal employees. They can't cut state or they can't cut municipal. So when they're cutting staff, that is at the federal level. Look at February 15th to February 22nd. 614 jumped 1,000 over the week. The prior year, during that period of time, was 330. This is where we're going to see the effect of DOJ. So when they keep telling us, oh, we cut this many people, 200,000 people here, 100,000 people here, we'll see it in initial jobless claims. We'll have those numbers because when you show up and you say, hey, I would like to get unemployment, you're categorized so they know exactly where you are. So we're getting exact counts here. I found this interesting. Look at this over here. This is initial jobless claims week over week. Look at New York State last week, or the week ending prior to this report, the previous week, 14,538, almost 100%, a little over 100% jump to 30,000. That's a big jump. District of Columbia, it breaks it down to District of Columbia as well, because this is where we would see probably the greater effect of any job cuts. Anybody working in Washington, you would expect to see something there. The week before, 1893, dropped to 1510. So that is sort of going in the wrong direction. So these numbers that we're seeing right now kind of tell a different story than what the administration is telling by saying we got head count down this much, we're saving this much money over here, we're getting rid of these people over there. It's, yeah, you're getting rid of some, but I mean, it's not really showing up in the numbers. Okay, let's move over to rates and yields. And another volatile week in yields. We're up, we're down, we're up, we're down. This week we're down. Look at the bottom of the screen. TLT down 2.52% week over week. SPX took it even harder, down 3.1%. And anybody who's been watching this market knows that all of this volatility really comes down to one variable controlled by one person. And that's tariffs. This on again, off again, on again. I'm threatening you with tariffs. You get tariffs. No, you don't get tariffs. No, you do get tariffs. No, you don't. You get, you know what I mean. Like it's so hard to follow that by the end of the week, I was all confused thinking, okay, are there still tariffs on anything? Apparently there are still some tariffs on Canadian goods that do not meet the USMCA agreement, which seems odd because the agreement is the agreement. And the Canadian retaliatory tariffs are still on. The exit tax on energy is expected to go in effect on Monday, which I think is a brilliant move on Ontario's part. It's a way of raising the price to Americans, and Canadian government gets the tax revenue, or the Ontario government gets the tax revenue for it because it's an export duty. I don't know what's going to happen there, but really volatility comes down to just that. And last week, it appeared that the market had had enough of it, so that even when there was an announcement made that, okay, tariffs are removed except for a very few small categories, the market continued to sell off, and another market was the beneficiary. And we'll have a look at where money seems to be flowing right now. Money market rates, all well behaved, all the way out to the 1 year, which we would expect to be. If we look at FOMC, we have a meeting in 10 days. The probability is increasing on 25 basis point cut up to 12%. Still the smaller part of the probability, but almost double from the week before, from 6.5 to 12. 88 on zero. I don't expect much. Powell spoke on Friday, and he seemed to be quite clear. You know, we can wait, and we're going to wait, and the economy is fairly strong right now. It is not caving in under its own weight. If the economy falters, it does come down to the uncertainty created by one policy, by one man, right? So we cannot ignore it. If you were in the market last week, you cannot ignore it. Capital market, we have a steepening in the capital market curve, but from the beginning of the year to now, we do have yields on the long end of the curve lower than when we started the year. And I think this is what we're going to get. The blue line is this week, the red line is last week, and we'll probably get something like this, and then we'll go back to here, and then we'll go back to here, and until this tariff nonsense is put to rest. March, the next Friday or the Friday coming up, we're expecting the steel and aluminum tariffs. April 2nd, we're expecting retaliatory tariffs. China got handed another 20%. China hit back at the U.S. and hit back at Canada. Mexico is talking about hitting China with something to satisfy the one guy that needs to be satisfied. This must all end. There are no winners in any of this, and we're seeing this because it increases uncertainty. Uncertainty increases the discount rate. Increasing the discount rate reduces the present value of all future earnings. Markets have to go lower. We get jolts in 2 days. Typically, you get the jolts report in the week that you get the jobs report. We get jolts this Tuesday. I didn't look around. You know, I mean, I get the question in my head of what's going on here, but I didn't look around to figure it out. If somebody knows why we're getting the jolts 1 week later than we normally would, usually it's in the week that we have the jobs report. If somebody knows why, let's put it out there. U.S. CPI in 3 days, that's going to be a big one. That's going to be market moving. For core, the expectation, the F sub C is forecast core is 0.3. For headline, it is 0.3. Let's keep our eye on this. Bank of Canada rate decision in 3 days. It is expected we're going to get a 25 basis point rate cut out of the Bank of Canada simply because of all of this tariff uncertainty. And if on April 2nd, there are retaliatory tariffs, because he is talking about certain things in Canada. He wants to redraw the border, by the way, and take everything in southern Ontario from Toronto down to Windsor. I mean, that's some dictator stuff going on there. So there's that you got to deal with. So the expectation is you're going to get a 25 basis point cut. A tariff on steel and aluminum. Steel, that would hurt Hamilton. Significantly so, and it probably hurt the auto industry as well. Yeah, I think that if it does happen, there'll be a reversal again. PPI, 4 days. Initial jobless claims, we get that every Thursday. We're going to start watching the initial jobless claims for that one category, federal employees. Consumer sentiment, that sort of affected the market last time. We get that in 5 days. Reverse repo pulling back now at 136. Reserves at 3.38. So it run off at 40 billion a month, 25 months. But I think in 10 days we're going to get probably some questions on the balance sheet, because there's just this outstanding issue of, you got mortgage-backed securities. Besant wants a 10-year lower. I see a deal. I'm surprised that more people aren't talking about it, but I see it. The level of agency MBS, I've written it down for you here, 2.195 trillion. Getting out of agency MBS and into the 10-year, that's a little bit tricky, because you don't want to affect mortgage rates. So you have to do it at a speed and using securities in a way to get that done. If you know what a dollar roll is, they can just engage in the second leg of the dollar roll, which is just the selling. If there's buying of the front month, selling of the second month, they could probably engage in the latter leg of the dollar roll through derivatives, and probably move a lot through derivatives without it hitting the market. I don't know enough about the size of that market really, and about the demand from mortgage REITs for that at this time. So it's one avenue to get out, but I'm sure they could structure it in the way such that they're neutral. I don't think they would want to purposely try to affect the 10-year. I think if they do anything, they'd say, look, we'll go neutral and the market can set the rate, but we'll try to be as neutral as possible. Sell MBS, buy the 10-year in such a way that the two offset each other. But I think it is worth talking about this. And steel and aluminum, I put 7 days because it was Friday when I made this screen. It is 5 days from where we're sitting. Steel and aluminum happened on Friday. We are still inverted on the 3-month to 10-year, but only 2 basis points, but still inverted. Looking at the Fed funds futures, pricing in a lot more rate cuts now. If we go through all the quarters, we got 75.5 basis points priced in to the end of this year over the next 7 meetings. So that is basically 3 25 basis point cuts in 7 meetings. I think that's a little bit more realistic. At this point, you'd look at that and say, well, as a base case, that's where I would be. Unless our guy in Washington changes his strategy, changes his behavior, and drops the tariff stuff, then I think 3 is too low. You're probably looking at 5, 6, maybe even 7, because tariffs will destroy. And it's not just the tariffs, it's the counter tariffs to your tariffs that will destroy. And I think Besant has it right. If he has any influence in this one, it's, look, get rid of this tariff stuff. Stop with that nonsense and lower the value of the dollar. Let's get the long end of the curve down. And if we get those yields down, it makes the dollar less attractive. Let's get the dollar down. That can do a lot of heavy lifting. If you can get the market to believe, to have confidence that you're going to pursue a weaker dollar policy, money will move away from the U.S. dollar. Nobody will bet against it. They'll bet in your favor. They'll lower that dollar, and you can change the balance of trade with a weaker currency without affecting industries, without retaliation, without raising negative sentiment. You can get a lot of things done. You get the Fed on your side. Listen, Powell, why don't you sell some of those MBS and buy the 10-year? We'll start working on the long end of the curve ourselves. We'll drop all of this tariff talk, and we'll talk about pursuing a softer dollar policy. We'll get this done. You could get a lot done, and you could probably have a great equity market if you get that done and get to that conclusion. But it requires a gentleman, not a tough guy, a gentleman, a gentle approach. I don't know if Trump wants to drop the tough guy image and go for that. That's the tough one. It comes down to can they convince him to go that way? If he goes that way, it wins for everyone. As it stands, if he continues on with his threatening, I see the U.S. dollar heading down. If he decides to stop the threatening and pursue a weak dollar approach, I see the U.S. dollar going down. What happens when you come to the same conclusion regardless of which way you go? You have a trade. So I think that the trade going forward is a weaker U.S. dollar. I think strong dollar policy is done for a number of reasons. Number one, Europe has shown an absolute willingness to go it alone without the U.S. They don't really need the U.S. The administration sided more with Moscow than with Ukraine, and Europe rallied around Ukraine, strengthened Ukraine, showing a willingness to actually not need the U.S. So maybe it isn't Fortress U.S. Maybe it isn't American exceptionalism. So maybe we don't really need a strong U.S. dollar if other countries can say, you know what, we don't even need the U.S. So I think going forward, it just makes sense to be short the U.S. dollar at this point. I am now short the U.S. dollar against the Canadian. I think about 1.8 million. I'm short the U.S. against the Canadian specifically. And I'm thinking this week of a long position in the euro. Just looking at what's going on and the chart, I think we can see 112, 111, 112 on the euro. I'll talk about that as we get to it. I had a request to revisit real yields, corporate spreads, and mortgage rates. Some interesting things in corporate spreads. I mean, how many weeks did I do corporate spreads with nothing to see here? And I just simply stopped doing it because there's just nothing to see here. Well, I think we have the starting of something to see. Let's look at real yields. We're all below 2% except once you get out to the 20-year, the 5-year at 1.57. Week before was very low. The 10-year 1.86 up to 1.99. Inflation expectations coming down. Looking at OAS. So what I've done here, this is week over week. So week over week, we can see they've all spreads have widened. I found for the year the low point on the OAS. So February 18th, January 22nd. February 18th was a low point for much of the curve, and then we have January 23rd. So if we look at CCC, January 23rd was 6.9 or 690 basis points. We're 790 basis points now. That's an increase, a widening of the spread on CCC of 100 basis points. Double B, February 18th at 156, we're 189. That's a widening of 33 basis points. February 18th on the triple B, 0.98, and now we're at 1.09. It's an increase of 11 basis points. And you can just see that that was so close to 100 basis points. That's 11% widening, roughly about 11%. 7 basis points widening here, 40 over here on the high yield index, 2.59 on January 22nd. We're 2.99, widening of 40 basis points. Justifiably so, I think. It's about time that, the market in that space is. Have you guys seen what's going on? Shouldn't we get a little bit wider here just for the uncertainty? It would be odd if the OAS was still saying, look, there's nothing to see here, go away. Mortgage rates on the 30-year, we're at 6.63. It hit a high of 7.04 on January the 16th. And on the 15-year fixed rate mortgage, 5.79, hit a high of 6.72. You can see where the low was going back to near the end of September before the Fed started cutting rates. It got to 6.08 and then just ran all the way up to 7.04. That's about adding, about 96, we'll call it 100 basis points on the mortgage rate as the Fed funds rate came down 100 basis points. And we're starting to come back. Initial mortgage applications, we're just hitting big negative numbers here. We're starting to see positive numbers down here. If we can get that back to the 6 and even print a 5 on this, housing would become very attractive. So let's hope that there is some plan on getting the 10-year down in a way that doesn't increase mortgage rates, but that mortgage rates would follow the 10-year down. If you can get the 10-year down. Where are we on the 10-year? Let me have a look here on the previous screen. We're at 4.32. You get the 10-year under 4%. I think most of that will feed through right to the mortgage rate. You can get that down to 6.3, 6.2. I know it still sounds high compared to previous previous periods of time, but a 7% mortgage rate was killing the U.S. Get that under 6%. There's the path to make America great again. Right now, it's make America poor again, make America small again, make America low value added again. Almost everything we've seen is not making America great again. I can't believe that all of that is lost on that guy. He must be seeing the effect that he's having. I don't know if you watched some of the White House press conferences he has, where he's sitting at his desk, he signs an executive order, and then he answers questions. Later in the week, it was Thursday, when he had made the announcement that he had removed a bunch of tariffs on anything that satisfied the trade deal. If it falls under the trade deal, okay, let's remove it. He didn't have the same bravado. He wasn't just as braggadocious as he normally is. He almost seemed defeated. That I think he was surprised that the market didn't respond to him and it still kept selling off, that he was getting a vote of no confidence from Wall Street. I think he was surprised that Europe got together and was able to come together and make a deal without the U.S. I think a lot of this has taken him off guard, because I think he went into this thinking, look, the world needs us. We are the world. The world will bend to my will. And he's seeing that it isn't, and I think there's some reevaluation going on. New York Times had a story about some of the tensions going on inside some of the cabinet meetings. So, I don't know, maybe as the taxpayer flies him back to Mar-a-Lago this weekend to pay for his golfing outing again, because I tell you, I don't know that any president has golfed as much as this guy on weekends. Every weekend you got to fly him back home on the taxpayer bill. All about lowering government expenses, you see. The hypocrisy, right? Unless there's some major shift here, something's got to break, something's got to give. I was in the Discord, on our Discord server, and I was doing a live in the market outlook, and there was some question about who's going to quit first or who's going to get fired first. And I said Polymarket should have a bet on that, about who's going to get fired first or who's going to quit first. Turns out they do. You can actually bet on who's going to quit first and who's going to get fired first. So there we are on our real yields. There's really not much to see in the real yields. I find the OAS is starting to get interesting. So we're going to continue to follow this and see where the OAS is going. And I think the mortgage rates will continue to follow that. I don't know that we're getting a lot of interesting information out of the real yields until they either go, well below 140, 130 basis points or well above 200 basis points across the curve. I think they're sort of in an uninteresting zone right now. This is interesting to keep our eye on, the break-even rates as well. Okay, SPY. Look at that slide at the end of the chart here. SPY is now down 6.13% from its all-time high of 612.30. And it's really not earnings, and it's really not the economy. If you look at the forward four-quarter operating earnings, holding the 270 range. It was 270.29 last week, 270.40. These aren't big moves, but they're not falling off a cliff. The underlying economy and the ability to generate earnings in that economy are there. What we're getting in this over here is heightened uncertainty, which gives you lower valuations. Closing SPX 57.70. The 10% correction mark, which I've noted down here, is 551.07. We ended at 574.71. You are $23 down on SPY. Roughly 230 points down on the index from hitting the correction territory. You look at IWM and IJR, the small caps, they're well in correction territory. IWM is down almost 15% off its high, and same with IJR, down about 15% off its high, and they both had very bad weeks as well. With the combination of earnings and the closing SPX, still an elevated forward multiple, 21.34. So if we can get down to a correction territory, given that earnings are 270, it takes almost a full multiple off. You'd be about 20.5, 20.4 on the forward multiple. We're down off the 22s, 22.03. Look at the implied volatility, 13-week 98th percentile, the 26-week IV 99th percentile, 52 98th percentile. The at-the-money short straddle is 3.52%. That means if you sell the call and you sell the put and you divide it by the strike, it's 3.52%. For the longest time, it was under 2%. Like, you just weren't getting very much selling premium. Now you can. I looked at a risk reversal. It doesn't make a lot of sense. You'd have to go, if you're looking at April, you're going $20, $25 up to buy a call, and you're financing it with a put that's $10 down. That's not a payoff that I like. That needs to be the other way. So if we do hit correction territory, hopefully skew will increase, which makes risk reversals attractive to do. But right now, the risk reversal is not very attractive at all. In the week coming up, 5 companies reporting earnings. Look at that. They both agree, because the number's small enough that they can manage it. These very large companies that sell you data can now manage it because there's only 5. Notables, Tuesday, Oracle. Wednesday is Adobe and Dollar General. I don't know that these are going to move markets at all. I'd like to say the CPI is what everybody's waiting for, but there's one guy in Washington with a mouth, and it's what he says. Everything could be fine, and suddenly you got those red bars again, right? So I don't even know how to play that one other than say we do not have an investing market. We have a trading market, which means there is only one play, and that is vol. You have to know how to trade vol. If you are an investor in these markets, go away, because it's just going to make you seasick. I'm up, yay, okay, things are over. No, they're not. Yes, they are. No, they're not. But with vol, you want that to continue, because that's where you make money. Look at this. This is really impressive. The IV last on SPY, 20%. Finally, equities showing that they are volatile, in fact, up from 15.4, and TLT down 14.5 from 14.7. Open interest still over 2 for the put-call ratio. I shouldn't say open interest. The put-call ratio that is still open over 2, and it did increase for TLT to 0.54. I want to show you something that I saw in Barron's, the headline that I saw in Barron's. So there is a lot to see on this screen. I got 3 charts up on the side: Germany, France, Spain, and I have the U.S. down here in their major equity indexes. But this caught my eye right away. Investors are in a bad mood. This time, they might be right. Trump's policies have given a boost to markets outside the U.S., causing some on Wall Street to quip that MAGA has been replaced by MEGA, Make Europe Great Again. And let's just take a quick high-level view. These are all year-to-date charts. So year-to-date, Germany's main index up 14.9%. I think you're at least on any ETF in the U.S. that I could track, at least 10-year highs on that. 10-year highs. France is up 9.83% year-to-date. Spain is up 13.5% year-to-date. The euro is up 4.32% over the last month. 4.04% of that in the last 5 days alone. We have a 52-week high on the pair of about 1.15 to about 1.12. We're sitting at about 1.085 right now. I think we get there. Look at the U.S. year-to-date, negative 1.68%. Negative 1.68 versus up almost 15, up almost 10, up about 14. The euro, even the currency alone, is beating the S&P 500 with the magnificent 7. Not so magnificent anymore. Now this has nothing to do with the economy. It has very little to do with their earnings as well. It really comes down to one thing. It has to be abandoned. So no matter which way we get out of this, whether we continue on with the tariffs or whether we abandon the tariffs, I say we now, and we as a collective, as a market here, whether we abandon the tariffs and pursue a soft dollar approach or a weak dollar approach, I do see the dollar's path naturally being downwards. So I am very interested in the European market. We were on our sessions down here in Costa Rica. We did some momentum screeners. And it is amazing at what shows up on the momentum screeners. If you run one of these, you know what you're going to find? You're going to find a whole bunch of U.S. listed ETFs tracking European stocks, all hitting 52-week highs. You're going to find a whole bunch of European listed ADRs, all hitting 52-week highs. Now, because that's a momentum screener, you know who else is seeing that? Momentum traders, which means more are drawn to that trade. And if you are a European investor holding SPY or holding Triple Q, over the last week, you saw that currency move heavily against you while your underlying was falling as well. So your losses are even greater. If you were holding SPY, SPY was down 3%. And if you're a Eurozone investor, the euro is 5% stronger, meaning the dollar lost 5% and the market index lost 3%. You're down 8%. Time to bring your money home. Because that's not going to end. I think the near term on this one is the euro, probably over 110. You get over 110, you'll run to 112. And again, unless the U.S. changes course, this will continue on. And it's not even the U.S. I'm sorry, I know some of you don't like it when I keep pointing out one person, but it really is one person's policies. Unless he changes course, it'll continue on. If he does change course, the more likely outcome is he'll pivot over to Besant's strategy, which is a weaker U.S. dollar. If you're a Eurozone investor right now, I don't know that there's any upside for you in terms of the currency exposure. All you can hope for is a strong U.S. market. But to get that, you have to abandon tariffs. Once you do that, you get a weaker U.S. dollar, which means the euro strength will work against any long position you have in equities. I'm not the only one that can figure that out. So money has been going back home. There's why you have Germany, France, Spain, all hitting multi-year, if not decade highs, all-time highs. In the U.S., I think a lot of more institutional investors are probably seeing that, okay, we've probably hit the peak on the U.S. dollar index for this cycle, and that the pathway seems to be downward. So gold and copper seem to be the most obvious winners. Copper, you can play the contract, but it's a big contract. But you can continue rolling it over. They're in contango, so nobody likes to roll things over when you have to buy on an upward sloping curve. I think for copper, FCX makes the best bet because they are a U.S.-based company. And I think short the U.S. dollar. I am short the U.S. dollar against the Canadian, and this week coming up, I'm probably going to open some positions in U.S.-listed ETFs that track European companies, and maybe even the euro itself, although I'm not a big fan of playing just the straight currency on a currency I don't need. I can always use Canadian dollars. I can always use U.S. dollars. Even pesos I can work with, but euros, it's a whole continent away. There's a whole ocean away, as Trump says. There's an ocean between me and them. All I can do is convert the euros back into either Canadian or U.S. So it purely is more speculative because the outcome has no utility for me other than profit or loss. So I don't know that I'm too eager to play the euro itself, but certainly some of the listed ADRs, and because there I get two things, right? I get a market that's going up because I think more dollars, more currency is flowing back into European stocks, and I get a weakening dollar at the same time. So I get two returns out of that one. So I would probably look at adding some momentum plays on U.S. listed ADRs or U.S. ETFs that track euro markets, and get the return on both of those. And that's about it for this week. I wish I could talk about more, but really it comes down to what is this one guy going to do? Is he going to double down and triple down in the face of what seems to everyone clearly obvious that this is not working for you? This is not making America great again at all. It is isolating America. The amount of anti-American sentiment that's building up around the world, and that doesn't change easily. That persists even if you can solve all of this. If you're going to pivot, you got to pivot now. So if he's going to double down and triple down during the week, if those tariffs come in on Friday, I see no reason to be long the U.S. dollar. I see no reason to be long U.S. equities at all. I would want to increase my short position probably quite heavily at that point, because this is just a one-way trip down in the valuations of companies that are subject to this. Anyways, that's it for this week.